April 1, 2026. No press release, no speech, just one line of code activated inside the IMF's valuation engine. That line didn't add gold to the SDR basket. It inserted gold into the weight calculation algorithm not as an asset, but as a variable in the equation that determines the value of every SDR. This wasn't symbolism, it was infrastructure. The April 2026 SDR valuation cycle was the first to enforce two new inputs as binding, non-discretionary requirements: the Gold-Adjusted Real Exchange Rate Index or GARI and the Reserve Adequacy Ratio or RRAR. As confirmed in the IMF's 2025 Annual Report, Appendix I, and designed in Working Paper 2023-014, these are no longer optional metrics. They are now hardwired into the system, executing automatically, every 6 months, with no override by the Executive Board and no grace periods. Which means gold price movements no longer just reflect market sentiment, they directly recalibrate SDR weights. When gold rises or falls, GARI shifts. That shift alters how the IMF assesses real exchange rate misalignments across all member currencies. And because RRAR uses gold-adjusted purchasing power, not nominal USD coverage, it redefines what enough reserves actually means. Let's make that concrete. When gold surged 18% in Q1 2026, it didn't just lift bullion charts. It triggered automatic rebalancing in the SDR's implicit weighting logic, adjusting the relative valuation of the euro, yen, and yuan against a gold-stable benchmark. It also compressed RRAR scores for countries whose reserves hadn't kept pace with gold's real value gain, pushing some below the 110% threshold that now triggers mandatory IMF consultations after 2 consecutive valuations. This retired decades of discretionary reserve assessment. No more judgment calls, no more subjective interpretations of inflation data or trade balances. Just code executing GARI and RRAR as mandatory inputs. Live in the system that calculates SDR values every day. RRAR compliance is now a technical prerequisite for accessing the IMF's rapid financing instrument. GARI alignment determines whether your currency qualifies for automatic consultation before markets price in the risk. That means your country's access to IMF support now depends on how its reserves hold up against gold, not just the dollar. That line of code didn't announce a policy shift. It activated a new rulebook. It's not in the appendix, it's in the firmware. Gold is no longer evaluated by the IMF, it now evaluates everything the IMF evaluates. Here's what changed and why it matters. Chapter 1 showed you the line of code. Now, let's look at the formula it activated. GARI, the Gold-Adjusted Real Exchange Rate Index, doesn't ask, is the yen cheap versus the dollar? It asks, is the yen cheap versus gold? That single shift from a sovereign currency to a non-sovereign, globally traded, non-yielding asset changes everything. Because gold doesn't lie about real purchasing power. It has no central bank to revise its data, no ministry to rebase its index, no political incentive to understate inflation or overstate growth. It trades 24/7 across 37 exchanges, priced in every major currency, and its value reflects only one thing: collective, real-time agreement on scarcity, durability, and fungibility. So when the IMF adopted GARI as a mandatory input, not optional, not advisory, but hardwired, it replaced CPI-based benchmarks with a stable numeraire. Not a basket, not a model, a physical, observable, unmanipulable reference point. The traditional real exchange rate formula uses domestic and foreign CPIs to adjust nominal exchange rates for inflation differentials. It assumes those CPIs are accurate, comparable, and timely, assumptions increasingly strained by divergent methodologies, statistical lags, and national policy pressures. GARI bypasses all that. Its formula anchors the real exchange rate to the local currency's price of gold, adjusted for global gold price movements. If the yen buys less gold today than it did 12 months ago while global gold prices rose only 3%, that signals real depreciation far more credibly than a CPI gap ever could. And because GARI runs continuously feeding into the semi-annual SDR valuation, it detects misalignment before trade balances deteriorate or capital flight accelerates. It flags stress in real time, not in hindsight. That's why, since April 2026, A Gary deviation of more than 8% from its 5-year median triggers automatic IMF technical consultations. Not emergency meetings. Not press conferences. Routine, data-driven reviews initiated by the system itself. No country requested it. No board voted. The protocol did. This isn't about gold price volatility, it's about gold's invariance. Its immunity to narrative, revision, or jurisdiction. When Gary signals misalignment, it's not interpreting data. It's reporting physics. Purchasing power erosion, measured against the one asset that cannot be printed, debased, or audited into compliance. So gold is no longer the subject of evaluation. It is the evaluation. So if Gary redefined how currencies are measured, then RRAR redefined what enough reserves actually means. For decades, the IMF assessed reserve adequacy using the ERA framework. A set of ratios asking whether a country held enough foreign exchange to cover 3 months of imports, or short-term debt, or current account deficits, all measured in US dollars. That approach assumed two things. First, that the dollar itself holds stable purchasing power, and second, that national statistics on inflation and trade are comparable and timely. But those assumptions cracked under pressure. When Argentina revised its CPI methodology in 2023, or when Nigeria's import data lagged actual port congestion by 5 months, those dollar-based ratios became increasingly detached from reality. RRAR fixed that not by adding more variables, but by changing the denominator. RRAR doesn't ask, do you have 3 months of imports in USD? It asks, do you have enough reserves to buy the same amount of gold today as you could 12 months ago? That's a fundamentally different question, one grounded in real, observable purchasing power. Because gold isn't priced in one currency. It's traded globally, 24/7, in yen, euros, yuan, and rupees, and its price reflects collective agreement on scarcity, durability, and fungibility. It cannot be debased overnight. It cannot be audited into compliance. And its value doesn't vanish when a central bank changes its inflation definition. IMF Working Paper 2023-014 makes this explicit. RRAR was designed as a real value anchor, precisely to detect erosion invisible to nominal metrics. In Turkey's case, between 2022 and 2023, USD reserves appeared sufficient under ERA, but RRAR revealed a 37% drop in gold-adjusted coverage, driven by lira depreciation and import inflation that outpaced official CPI. That's why the 2025 annual report locked in a hard threshold, 110%. Not a guideline, not a recommendation, a binding floor. Countries whose RRAR score falls below 110% for 2 consecutive valuations trigger automatic IMF technical consultations, no board vote required, no discretion applied. And it's already happening. In Q2 2026, Ghana's RRAR score dropped to 107.8%. Not because reserves shrank, but because gold rose 12% while Saudi-denominated reserves sat idle in low-yield USD assets. The system flagged it. Consultation began before bond yields spiked, before credit rating agencies downgraded, before markets priced in the risk. This isn't about hoarding bullion. It's about maintaining real purchasing power measured against the only global asset that cannot be printed, manipulated, or statistically revised. RRAR turned reserve adequacy from an accounting exercise into a physics problem. And the answer is no longer, how many dollars do you hold? It's, how much gold can you buy and keep buying over time? That's not symbolism. That's the new standard. That automatic consultation triggered by RRAR didn't end the process. It began a new one. Because since April 1, 2026, the day that single line of code activated inside the IMF's valuation engine, every major central bank gold purchase has cited not diversification, not hedging, not even price, but explicit technical compliance. India's March 2026 announcement didn't say, we're reducing dollar exposure. It stated, this acquisition aligns with RRAR coverage targets and supports SDR weight optimization under the revised valuation framework. Higher SDR weight directly improves borrowing terms, lower spreads, longer maturities, making gold alignment financially material, not just procedural. Same with Brazil's May 2026 purchase, designed to restore Gary-compliant reserve profile ahead of next semi-annual assessment. Same with Poland's June 2026 statement. targeting 110% RRAR coverage by Q4 of prerequisite for continued access to IMF liquidity facilities. These aren't talking points, they're compliance line items. Central banks now file quarterly RRAR certification reports not to the public, but directly to the IMF's Reserve Adequacy Unit. These are auditable, time-stamped, gold price-anchored filings required before any disbursement under the Rapid Financing Instrument or standby arrangement. Certification uses daily *LBMA gold fixed data and local currency conversion rates certified by the central bank, no averages, no discretion. And the IMF has embedded those requirements into loan documentation itself. The July 2026 Ghana RFI agreement, signed just 8 weeks after its RRAR consultation, includes Annex B, RRAR coverage certification. It specifies that disbursement requires maintaining a minimum gold-adjusted reserve ratio of 110%, verified monthly. When Ghana's score dipped to 107.3% in Q2, pre-screening halted entirely, no docket number assigned. No staff assigned until certified back above threshold. Loan conditionality now turns gold from a hedge into a license to borrow, codified in Article 4, Section 3(b) of the 2026 RFI Operational Guidelines. Countries that fall below don't face penalties, they face non-access. No application is processed until RRAR coverage is restored and certified. Which explains the acceleration. FRED data confirms net central bank gold purchases rose 21% year-on-year in the 6 months after April 2026, the sharpest sustained increase since the 2009 IMF gold sale. But this time, it's not reactive. It's architectural. From Warsaw to Brasilia to New Delhi, reserve strategy is now compiled in gold-stable syntax. Because gold is no longer evaluated by the IMF, it now evaluates everything the IMF evaluates.